Hi everyone, today we start our series of videos about risk. So to start with, what is risk actually is? Risk is defined in financial terms as the chance that an outcome or investment's actual gains will differ from the unexpected outcome or return. Risk includes the possibility of losing some or all of original investment. Quantifiably, risk is usually assessed by considering historical behaviors and outcomes. In finance, standard deviation is a common metric associated with risk. Standard deviation provides a measure of the volatility of asset prices in comparison to their historical averages in a given time frame. Overall, it's possible and prudent to manage investing risk by understanding the basics of risk and how it's measured, learning the risks that can apply to different scenarios and some of the ways to manage them holistically will help all types of investors and business managers to avoid unnecessary and costly losses. The basic of risk. Everyone is exposed to some type of risk every day, whether it's from driving, walking down the street, investing, capital planning, or something else. An investor's personality, lifestyle, and age are some of the top factors to consider for individual investment management and risk purposes. Each investor has a unique risk profile that determines their willingness and ability to withstand risk. In general, as investment risk rise, investors expect higher returns to compensate for taking those risks. A fundamental idea in finance is the relationship between risk and return. The greater the amount of risk an investor is willing to take, the greater the potential risk returns. Risks can move in various ways, and investors need to be compensated for taking on additional risk. For example, a US Treasury bond is considered one of the safest investments, and when compared to a corporate bond, provides a lower rate of return. A corporation is much more likely to go bankrupt than the US government, because the default risk of investing in a corporate bond is higher. Investors are offered a higher rate of return. Quantifiable risk is usually assessed by considering historical behaviors and outcomes. In finance, standard deviation is a common metric associated with risk. Standard deviation provides a measure of the volatility of a value in comparison to its historical average. A high standard deviation indicates a lot of value volatility and therefore a high degree of risk. Individuals, financial advisors, and companies can all develop risk management strategies to help manage risks associated with their investments and business activities. Academically, there are several theories, metrics, and strategies that have been identified to measure, analyze, and manage risks. Some of these include standard deviation, beta, value of risk, and the capital asset pricing model. Measuring and quantifying risk often allows investors, traders, and business managers to hedge some risks away by using various strategies including diversification and derivative position. Riskless securities. Uh, while it's true that no investment is fully free of all possible risks, certain securities have so little practical risk that they are considered risk-free or riskless. Riskless securities often form a baseline for analyzing and measuring risk. These types of investments offer an expected rate of return with very little or no risk. Oftentimes, all types of investors will look to these securities for preserving emergency savings or for holding assets that need to be immediately accessible. Examples of riskless investments and securities include certificate of deposits, government money market accounts, and the US Treasury bills. The 30 days US Treasury bill is generally viewed as the baseline risk-free security for financial modeling. It's backed by the full faith and credit of the US government, and given its relatively short maturity date, has a minimal interest rate exposure. Risk and time horizons. Time horizon and liquidity of investments is often a key factor influencing risk assessment and risk management. If an investor needs the funds to be immediately accessible, they are less likely to invest in high-risk investments or investments that cannot be immediately liquidated, and more likely to place their money in riskless securities. Time horizons will also be an important factor for individual investment portfolios. Younger investors with longer time horizons to retirement may be willing to invest in higher risk investments with higher potential returns. Older investors would have a different risk tolerance since they will need funds to be more readily available. Morningstar Risk Ratings. Morningstar is one of the premier objective agencies that affixes risk ratings to mutual funds and exchange-traded funds. An investor can match a portfolio's risk profile with their own appetite for risk. Types of financial risk. Every saving and investment action involves different risks and returns. In general, financial theory classifies investment risks affecting asset values into two categories: systematic risks and unsystematic risk. Broadly speaking, investors are exposed to both systematic and unsystematic risk. Uh, Systematic risks, also known as market risks, are risks that can affect an entire economic market overall or a large percentage of the total market. Market risk is the risk of losing investments due to factors such as political risk and macroeconomic risks that affects the performance of the overall market. Market risk cannot be usually mitigated through portfolio diversification. Other common types of systematic risk can include interest rate risk, inflation risk, currency risk, liquidity risk, country risk, and socio-political risk. Unsystematic risk, also known as specific risk or idiosyncratic risk, is a category of risk that only affects an industry or a particular company. Unsystematic risk is the risk of losing an investment due to company or industry specific hazard. Examples include a change in management, product recall, regulatory change that could drive down company sales, and a new competitor in the marketplace with potential to take away market share from a company. Investors often use diversification to manage unsystematic risk by investing a variety of assets. In addition to the broad systematic and unsystematic risks, there are several specific types of risk, including business risk. Business risk refers to the basic viability of a business, the question of whether a company will be able to make sufficient sales and generate sufficient revenues to cover its operational expenses and turn a profit, while financial risk is concerned with the cost of financing. Business risk is concerned with all the other expenses a business must cover to remain operational and functioning. These expenses include salaries, production costs, facility rent, office and administrative expenses. The level of a company business risk is influenced by factors such as the cost of goods, profit margins, competition, and the overall level of demand for the products or services that it sells. Credit or default risk. Credit risk is the risk that a borrower will be unable to pay the contractual interest or principal on its debt obligations. This type of risk is particularly concerning to investors who hold bonds in their portfolios. Government bonds, especially those issued by the federal government, have the least amount of default risk and such as lowest returns. Corporate bonds, on the other hand, tend to have the highest amount of default risk, but also higher interest rates. Bonds with a lower chance of default are considered investment grade, while bonds with higher chances are considered high yield of junk bonds. Investors can use bond rating agencies such as Standard and Poor's, Fitch, and Moody to determine which bonds are investment grade, which are junk. Country risk. Country risk refers to the risk that a country won't be able to honor its financial commitments. When a country defaults on its obligations, it can harm the performance of all other financial instruments in the country, as well as other countries it has relations with. Country risk applies to stock, bonds, mutual funds, options, and futures that are issued within a particular country. This type of risk is most often seen in emerging markets or countries that have a severe deficit. Foreign exchange risk. When investing in foreign countries, it's important to consider the fact that currency exchange rates can change the price of the asset as well. Foreign exchange risk or exchange rate risk applies to all financial instruments that are in currency other than your domestic currency. As an example, if you live in the US and invest in a Canadian stock in Canadian dollars, even if the share value appreciates, you may lose money if the Canadian dollar depreciates in relation to the US dollar. Interest rate risk. Interest rate risk is the risk that the investment's value will change due to the change in the absolute level of interest rates. The spread between two rates in the shape of the yield curve or in any other interest rate relationship. This type of risk affects the value of bonds more directly than stocks and is a significant risk to all bond holders. As interest rates rise, bond prices in the secondary market fall and vice versa. Okay guys, today we have spoken about uh, the risk, the meaning of risk, the definition. In my next videos we will take a deeper look on risk and how to handle risks. All for now, bye.